Hello, and welcome to Lemsa TV's Cityscope. I'm Carl Pimerini, and we have hopefully a very informative show for you today. We're going to be talking about something that is always questionable in people's minds as they reach certain ages, and that is long-term care insurance. We're going to find the whole skinny on what long-term care insurance is about, and we have a specialist here that's going to help us plow through all this and hopefully not confuse you too much as I'm confused, and we'll take it from there. So I'd like to take this second to introduce our guest tonight. It is Mark E. Gauthier of Northeast Brokerage Incorporated.
Thank you, Carl.
Nice to meet you. Thank you for coming to Cityscope. So it's a difficult topic. There's a lot of times people don't want to think about that, don't want to think about, okay, when I reached age 55 or 60, should I be thinking of some kind of supplemental insurance when Medicare doesn't work or whatever, you know, when you run out or what the deal is, how it all works. But what exactly is long-term care insurance? Let's start there.
It's a good question to start with. Long-term care insurance is coverage for what happens to us when our Medicare or our regular insurance does not cover us any longer. It covers us for what we call custodial care.
Okay.
All right. Custodial care are what they call the 6 activities of daily living. Some of those examples are feeding ourselves, showering, those types of things. There's 6 of them.
Okay.
Yeah. Continence is one.
Okay.
Transferring from your bed to a chair.
Right.
Basically, our regular insurance that we have before we turn 65 and go on Medicare will not cover that.
Okay.
And Medicare does not cover it. Mm-hmm. So what happens is there's a gap. Mm-hmm. And people typically, you know, when they reach the middle 80s is when this usually happens, is an event takes place. They maybe will have a stroke, break a hip, end up in the hospital. They then are sent to a rehab after this, say 7 days in a hospital. Mm-hmm. They're sent to rehab to get us healthy enough to go home, hopefully. Mm-hmm. And what can happen is people usually at that age can't go home.
Right.
And they go from what we call intermediate care, which is physical therapy, occupational therapy, into custodial care, which is the 6 activities of daily living, just the basic stuff we need to live. Or we have a cognitive impairment that says where it's unsafe for us to be home alone. Mm-hmm. So those are the things that are not covered, and if we don't have insurance to cover it, then we pay out of pocket, or Medicaid pays for it.
How long has long-term care insurance been? You know, it seems to have grown in popularity. Right now, I'm not sure where exactly it stands, but how long has it been?
Mid-60s.
Mid-60s?
Yes, and the companies did not have actuarial data like they do on life insurance and disability. Mm-hmm. And the policies were very, very underpriced at that time. And you're hearing the horror stories in the news about people receiving huge rate increases, companies getting out of the long-term care insurance business.
Right, exactly.
And that's all because of the lack of information that they had to price the policies.
Okay.
And as you and I were talking earlier, mm-hmm. there's 3 basic reasons that the companies are having a difficult time with long-term care insurance. Mm-hmm. And the first one is the amount of time that people are on claim is a lot longer than the actuaries thought it was going to be. Mm-hmm. You know, an Alzheimer's case can last 8 years. The second problem they're having, and I know people just love to hear about insurance companies' problems, they feel so bad for them, but the interest that they're able to get on their money, the reserves that they have, they can't put it into a quality bond to return 5%. Okay. And a lot of those old policies had a 5% inflation rider on it. Mm-hmm. So they can't, they have to take it out of the general funds. Mm-hmm. And the third thing that's happened is those policies that were written, the companies thought that there was going to be a lapse ratio of 10%. Meaning that 10% of the people that buy a policy eventually stop paying for it. So if a company has a policy on the books for many years and the client stops paying for it, that means the company gets to keep all that money and not pay any claims. In actuality, between 1% and 2% of the policies are lapsing. So people are making a decision to buy it and keep it. So those are the three reasons that, and where we are today with the long-term care.
Okay. Let's zero in a little bit more about it on the types of policies. This traditional is a combination. Can you explain just briefly a little bit about the differences?
Sure.
Okay.
The traditional long-term care insurance policy is the most comprehensive.
Okay.
Okay. It's going to cover us for care in the home, care in an assisted living facility, or care in a nursing home. Okay. There's all types of variations on how much coverage you buy, how long you want the coverage to last, whether or not you want inflation, whether as a couple you want to share the policy. And I find when I'm talking to a couple about a long-term care policy, it takes several discussions for them to really get their arms wrapped around the coverage,
Right.
and then to make a decision. And because there's so much of that goes on in terms of learning about it, once people make a decision, they're very happy with their decision,
Right.
and that's why they keep the policies.
Well, that's why we have people like you, specialists that can, let them know what's going on, fill in the gaps. It's always great to have an attorney present, and have an attorney there with you to discuss, what's going on. So what age usually, is there a usual age, a median age where people start thinking about or purchasing long-term?
Right. Can we go back just to the types?
Sure.
Because I did.
Oh, you didn't touch on the second.
I didn't
right.
get to, I didn't, because the long-term care insurance policies are expensive. Okay, and they're expensive because the companies are paying out millions of dollars every month in benefits.
Right.
The industry has developed what we call a blended product. And a blended product is a combination of a life insurance policy with a long-term care insurance rider on it.
Okay. That's what's known today as a combination. They call it a combination policy.
Right,
Okay.
that's right. So you can buy a whole life policy, very rich, everybody would love to have a whole life insurance policy.
Right.
Not everyone can
Right.
afford it.
Right.
A universal life policy, which is more affordable. And the reason people are looking at these, and a lot of them being sold, John Hancock has that rider, by the way, on 40% of their universal life policies. So it's very, very popular.
Yep.
And the reason for it is that policy guarantees that someone is going to benefit for all those premiums being paid over the years.
Exactly. Right.
Either the beneficiaries of the life insurance,
Right.
the insured for a long-term care benefit, or there's cash value in some of them where you can borrow it and use it for other things. And then the third type is an annuity.
Okay.
Okay. Sometimes people use annuities to cover a long-term care exposure.
Okay. It comes down to coverage, I guess. How do you determine how much coverage you need?
Right. And that's the question of all questions.
I know it is.
When you're talking about long-term care, traditional long-term care insurance, the first thing you determine is what monthly benefit. Okay. It's not like a homeowner policy where you buy it and no matter what happens, if your house burns down, they're going to replace it.
Right.
You have to decide how much coverage you're willing to pay for.
Okay.
So you buy a monthly benefit of $6,000, $8,000. Home care is covered by these policies. It's kind of wide open as to how much you're going to need for that, because you need 24/7 coverage.
Right.
Well, if that's the case, then it's more expensive than a nursing home. If you need, just a little care every day, then maybe that will work at $6,000 a month.
Nobody has a crystal ball to find out, what's going to happen down the line,
That's the
or
problem.
where you're going to be. There's so many factors, genetics, family history, health history.
Exactly.
It's just tough to, to put a handle on it.
So then, so you choose a monthly benefit.
Right. Yep.
And it's all, usually if I'm talking to someone, I have my computer with me and I can show them the different carriers and how
Right.
much it costs.
Right.
And, for, just to throw a number out there, the average 60-year-old who buys a policy, he and his wife, to buy meaningful coverage, it's going to be $5,000-$6,000 a year.
Yeah.
Okay? So couple that with, or contrast that with what it costs for a nursing home in our area. We were talking about this earlier.
Yeah.
You know, $11,000 a month.
Right. It's crazy.
You know? So if you talk to an elder attorney, they'll always recommend long-term care insurance, and they'll say, you know, the client usually says, and when somebody calls me about it, they'll say, I know this is very expensive. I don't think I can afford it. That's almost always what I hear when someone first contacts me.
Right.
And what I like to do is educate people as to what the options are, you know, with and without insurance. There is something going on right now, which we may get into if you want, what people are doing to avoid paying for the nursing home when they don't have insurance.
Yeah, well, I'd like to get into that. You know, once we go through this, I'd like to talk a little bit about that, because
So then,
that's
you know,
interesting.
you pick a benefit, a monthly benefit.
Right.
Then you pick the period of time, the benefit period. How long do you want the policy?
That was my next question. How long should they be insured for?
The attorneys will say 5 years, okay? Because with 5 years, you go on claim, and then you immediately give everything away to the kids.
Okay.
Okay. So 5 years is what they recommend. So you have $6,000 a month or $8,000 a month for 5 years. You multiply the benefit by the benefit period, and you come up with a total amount of coverage that's available. Well, I don't know what the number is. Let's say it's $400,000, okay? You're covered until you run out of the $400,000.
Okay.
All right. And every other person I talk to says, okay, it's a 5-year policy. I'm 60 years old. I buy it now. What happens when I'm 65?
Right.
The 5 years is actually when the claim goes in.
Right.
Okay.
Right.
But it doesn't even limit you to 5 years, because if you use the 400,000, if you don't use the 400,000, you can continue to go.
Right. Yep.
You then pick an elimination period. How long am I going to wait before I start getting benefits? It's like a deductible. Most people, it's 90 days is what they pick. Do you want inflation? Do you want compound inflation? Do you want simple inflation? Do you want to share the policy with your spouse? So there's a number of things.
Sometimes, you know, when you're dealing with insurance, an agent or a broker will give you a sample policy to look over.
Right.
Is that something you normally
Absolutely.
do a lot of people take advantage of that just to kind of see? Or
The sophisticated, educated
Right.
will ask for that, or I'll offer it because I'll sense it.
Right.
Most people just don't want to be bothered.
Right, right.
You
They
know,
just want the coverage. Just
Yeah,
sign me
they
up
just
and
wanna-
that's it.
Tell me, tell me it's too much and I can't afford it, that type of thing. I'm just being honest with what's going on out there, but it's so important. It's the biggest reason people lose their life savings. It is an uncovered long-term care.
How does a group certificate type differ from an individual type of policy?
Well, a group policy, there's fewer and fewer of them out there.
Okay.
But a group policy will be portable, typically, meaning when you leave your employer, you can take it with you and start paying for it.
Right.
It's, if you have an option, I really suggest people take a look at that.
Right.
I've sat with people and compared, and it's not available in most places.
Right.
But, I have evaluated that many times for people, and if they're better off with that, then I tell them to go ahead and get it.
Do you find usually the bigger companies
Yes.
have something like
Right.
it's not affordable for the smaller
Right.
ones to offer something?
Sometimes when you buy a long-term care policy, a fully underwritten one, an individual policy, there's different rate classes. There's a preferred and a standard.
Okay.
And sometimes, if somebody has really great health, they might be better off with an individual policy, because they may get preferred where everything under the group plan is a standard rate.
Okay.
They have to, they have to make allowances for the adverse selection, they call it.
Yeah. Now, can you explain a little bit about the tax qualification in terms of policies and what that's about?
Right. An individual long-term care policy is tax deductible to the extent that any medical expense is. So anything in over 7.5% of adjusted gross income is deductible. Most people with insurance don't have that type of medical bills.
Right.
There is a really, really good situation for a C corporation or an attorney's office, okay? CPAs.
Right.
They would all qualify for this. They could buy long-term care insurance policy on whoever they want. They can pick and choose who they want. They can cover their spouses. The company can pay the premium. The premium is 100% tax deductible, okay? And the benefit is received tax-free.
Wow.
Why this isn't the case for everybody, I don't know, but it's only C corporations.
Wow. We'll have to look into that. Can you explain a little bit about triggers? You know, in terms of long-term care, there's usually a trigger that sets things into motion.
Right. Triggers for the traditional long-term care insurance policy, the same as the federal triggers to be on Medicaid. One would need to have a need for help with two of the activities of daily living, okay? And the insured's doctor is the one who certifies this.
Right.
Activities of daily living: continence, transferring in and out of bed, feeding, dressing. A cognitive impairment is another separate one if it's unsafe for you to be home by yourself. Those are the triggers, and only those. If you can't read your prescription bottles, that doesn't trigger it. Okay?
And only the doctor can decide what the triggers are.
The doctor, and sometimes the insurance company will send somebody out to check on the doctor.
A different, right.
Yeah,
okay.
just to make sure.
Right.
So they want to pay the claims,
Yep.
but they don't want to pay a claim that isn't covered under the contract. So those are the same criteria that one would qualify for Medicaid
Right.
from a clinical standpoint.
Yep.
Medicaid in our state is MassHealth.
Right. Right. So usually a doctor will look and suggest that, you know, this could be a trigger, you know, whatever. But then the insurance company will send out somebody. They may.
Usually what happens at claim time is a family member will call, because usually when we're ready to go on claim, you know, we need help
Right.
with submitting the claim. You know, it's
Right.
it's something that usually it's a child
Yep.
that does it. You know, and this is why it's really important for the kids to know where the policy is and what the coverage is. And I really encourage when I'm talking to someone about this with an agent or by myself, is have the kids there.
Right.
So they'll hear all of this.
Right. Years ago when my father went through this, that's exactly what we did. We were all there when we heard the whole thing, which was, you know, it really made us aware of what's down the line
Right.
for us. But it's very educational, and that's why I feel it's important that people understand this and figure out the whole process so that they can, you know, they can take advantage if they can.
It doesn't cost anything to learn about.
That's right. That's
You
right.
know, it doesn't. We're not on, you know, we're not on a fee. We're not fee-based. We're
Right.
commission-based, and we don't make any money unless we sell it.
Right.
But a good long-term care person will answer questions and not try to sell somebody an insurance policy the first time they meet them. That's my opinion. There's other schools of thought on that.
How about homemaker services? Is that usually part of the
Yeah,
policy?
that's usually part of a comprehensive policy.
Okay. Is there specifics about that, or no? It's just basic.
You know, what the insured can't do as a result of his qualifying disability.
Okay. Okay. How about health history of the insured, of the person? How does that affect the cost? Quite a bit.
Well, it affects the cost and the availability.
Okay.
30%. My understanding is 30% of the applications are declined. Okay, meaning that something comes up in the underwriting process. So in answer to your question, on a traditional long-term care, I'm not talking about the life insurance one, a traditional long-term care
Right.
process is you complete an application, you give a deposit of 1 or 2 months, depending on the company. It goes into the company, they review the application, usually send for medical records to the doctors. Okay, the company pays for all of this.
Yep.
So the company decides yes, no, or we're not going to offer it at the rate that you quoted, Mr. Agent. Okay, we found this out, and so in general, if you use tobacco, you're never going to get a preferred rate. Okay, there's certain knockout questions that, you know, if insulin-dependent diabetes is now a problem.
Okay.
Okay, things that affect the cost.
Right.
If you've had a stroke, if you've had many strokes, you can have 1 mini stroke, and most companies will write it. So in answer to your question, it really does matter what kind of health you're in. That's why the younger you are when you look at it and apply, the better.
The
'cause
better you are.
typically, we don't get healthier as we go on.
Do you offer a choice of companies for people?
Yes.
In terms, okay. Is there a wide choice, or is it?
There's only about 5 companies left
Okay.
in Massachusetts.
Okay.
Many companies have gotten out of the business because of those 3 reasons we talked about earlier.
Right.
So, and this is the thing, and it concerns me, and I was mentioning we just lost one last week, that no company wants to be the last one standing.
Right.
You know, and the ones that are still out there are getting inundated with applications. So, you know, unless that they're going to come up with different ideas. One of the companies has a plan which I haven't been able to wrap my arms around with, is that we quote a premium, and the premium can go up or it can go down based upon how the company's investments go. And as an agent, I've been doing insurance for 40 years. I know what's going to happen is, you know, people buy a policy and they forget about it,
Right.
except what it costs, and if it goes up next year, they're going to.
They're gonna bail.
But this is their, in my opinion, this is their last try. That company. In other words, if this doesn't work, we can't stay in this business.
Right. You mentioned earlier about something that's relatively new coming that people are looking at. Can you fill me in a little bit about that, or something different? A different.
Oh, we're
way?
talking about people who don't have insurance.
Right.
Okay, this is not new.
Okay.
Okay, it's a last minute thing that people are doing.
Okay.
So in Massachusetts, a good percentage of the people in nursing homes are on MassHealth.
Yep.
In order to qualify for MassHealth, number one, you have to have those activities of daily living or the cognitive impairment. You have to qualify clinically, but you also have to qualify financially. Okay, and in order to be on MassHealth, a single person can only have $2,000 to their names.
Right.
Okay.
Wow.
A married couple, if you have a healthy spouse at home, can have about $121,000 between them. The house, all the contents of the house. So what's happening is, if people know an elder attorney, a good elder attorney, or know about this, they're able to, let's say somebody has $500,000, and so that would be, they have $380,000 that is a countable asset. I don't want to get too this doesn't get complicated.
Right.
But they can take the $380,000 and put it into a single premium immediate annuity in the name of the healthy spouse.
Right. A trust, sort of.
Is
it like a
it's
trust?
just an annuity.
It's just an annuity.
Yeah,
Okay.
yeah, it's an annuity. So
Okay.
you've taken a countable asset and turned it into a non-countable income stream.
Okay.
Because the money that comes into the house as income is not countable if it's in the name of the healthy spouse. All of it's countable if it's in the name of the confined spouse. So what people are doing is they're taking the 320 in that example, taking it right off the table. And
Is
that's the
there a
last
risk
minute.
involved with that? Or?
No. Well, the only risk is if the government decides that that's not appropriate any longer, and they don't allow it. But right now they are allowing it, and it's used constantly.
Okay, very good. This has been a little bit eye-opening and make people think out there of, you know, we should really start looking toward this when you reach a certain age, 55. I guess it's never too early to start thinking about it. You never know what's going to happen. Right. But thank you for, filling in the gaps and letting us know. Now, you're with Northeast Brokerage Incorporated out of Sterling.
Right, well, we're actually in Manchester, Connecticut. There's, there's 15 of us that do this.
But you can contact Mark at the number that was with his ID there. So, if you're interested, give him a call, get some more information. We are, not telling you to go with Mark, but if you need more information, he's there for you.
Thank you very much.
Thank you. Nice to see you.
Same here, Carl.
And thank you all for watching Cityscope. Take care.